So we're here today with Scott Higbee, senior partner and member of the investment committee at Portfolio Advisors. Scott, thank you so much for coming to Brazil and here to Carbyne Apex. Do you want to take a little bit of time to introduce yourself and speak a little bit about Portfolio Advisors?
Happy to do so, and thanks for the invitation. This is an amazingly beautiful country and happy to be here. Filipe and I have known each other for over 15 years. I actually used to be Filipe's boss, and it's really nice to see what he's done here in building his own firm and serving the investor community here in Brazil. My name's Scott Higbee. I'm a member of the management committee at Portfolio Advisors and a managing director. Our firm has been in business almost 30 years. We manage over $40 billion in private capital, headquartered in the United States in the Metro New York region. We have 140 professionals spread throughout the world, offices in Zurich, in London, in New York, Connecticut, in Dallas, in Singapore, and in Hong Kong. We specialize in the private markets. We are a mid-market specialist, and our view is the middle market provides the best opportunities on an absolute basis, but also affords us many relative value opportunities to take advantage of what the market situation dictates at a given point in time.
So tell us, why should someone invest in private markets or private equity?
Good question. I think equity is equity. And what's interesting is I think we've seen a convergence in recent years. It used to be that investors classified private equity as a pure alternative and in a separate bucket as public equity. At the end of the day, they're both equity-oriented investments. One has more liquidity and one has less liquidity. But with the rise of the private markets over the last couple of decades, I think you've seen a convergence, and I think rightly so. For smart investors, your equity exposure at the end of the day should be classified as equity, and those that don't have significant near-term liquidity needs, the upper end of that equity allocation should be private equity, in my opinion, and we're starting to see many institutional investors adopt that same mindset. Now the second part of the question, why private equity? Private equity is a misunderstood asset class. There's nothing magical about it. The same types of value creation initiatives in private equity are similar to what is needed in creating value and equity in a publicly held company. But there are four main reasons, in my opinion, that private equity has outperformed public equity and will continue to do so going forward. Number one is the competition. When I started my career 25 years ago, there were close to 15,000 publicly traded companies in the United States. Today, that is approximately 5,000. So it's the incredible shrinking universe of public companies. We estimate that there are anywhere between 180,000 to 200,000 companies, private companies in the United States in the middle market that are private equity candidates to be owned and operated by private equity investors. I like my chances of finding good value out of a universe of 180 to 200,000 companies relative to 5,000. Those mutual fund managers out there that are trying to find value or good opportunities in the public universe, they've got a really tough job because that's symmetrical information that's spread across that universe. In our case, we can spend a long time getting to find diamonds in the rough and spend a lot of time with management teams deciding if we want to pursue those types of opportunities. And one is competition. There's much less competition in the private markets than in the public markets, just the universe of opportunity is much bigger. Number two is information. We can spend months and years with management teams of private companies, getting to know them and better understanding their business and really getting, I would say, an informational insight that maybe other market participants could not get. And that's much different than what we see in the public equity marketplace. And then I think that leads to number three, in addition to less competition or a bigger universe, better access to information, I would also say we get better alignment of interests. So the CEOs of big publicly traded companies in the United States might own 0.1% of the outstanding shares. Yes, that is equity, but it's not the same as what we look for in the private markets. when we buy companies alongside our sponsors, we like to buy companies alongside management teams, alongside founders, to where they still have 20 or 30 or 40% ownership in the business. They succeed as we succeed, and they hurt when we hurt. That alignment that you're able to structure into private equity agreements is much better than you can on the public market side. We can also put stipulations in place in terms of liquidity preference, in terms of drag along, tag along. The private markets allow us to structure agreements to where we're aligned at the hip with owners of the business. So in addition to competition, the informational advantage and the alignment, the long-term nature of private equity really allows us a lot of flexibility and runway to make changes in a business that in the long term will be better. If you were to poll any manager that has worked for a private enterprise or a public enterprise, the vast majority would say they would prefer to manage a private company, because you're not beholden to the same types of time constraints in managing toward quarterly earnings announcements like you are in a public context. As a private equity owner, we can go in and we can make some tough decisions about what to do with a business, implement long-term strategic goals that in the short term might hurt the earnings or hurt the top line growth of the business, make some significant personnel changes if needed, that a public company management team would never be able to do. So over a 3 to 5 to 7 year time horizon, we've got a lot more flexible mandate and more patience in order to create value in a company than public company managers do. So just to sum that up, it's a bigger universe that allows us to have less competition in searching for deals, better access to information, better alignment, and finally the long-term outlook that is not really prevalent in public markets. Hope that answers the question.
No, it does. And as you know, here in Brazil, it's still early days in private equity. Not only the universe is smaller, but also investors are not that much exposed to the asset class. Not only the private investors, but the institutional investors. You have been in the market for a long time. What do you see investors doing in the US regarding the asset class? What are the type of allocations that they are willing to put to work in the asset class?
I think you've seen widespread adoption of private markets by US institutional investors. And I think by and large, you're starting to see other institutional investors across the world be able to mimic those types of allocations. I think here in Brazil, it's still in the early stages, but I would say portfolio managers understand the importance of private markets, and that includes real estate, that includes private credit in their portfolio. In fact, that's one of the I think underappreciated developments of the rise of private markets over the last 10 or 15 years is the shadow lending or direct lending by private firms has really replaced what the banks did 20 years ago. And as private equity is bigger by a factor of 5 or by a factor of 10 from what it was when we began our career, direct lending has largely replaced what the big commercial money center banks have done in the past. And I think that's a real opportunity as people see in today's interest rate environment to be able to loan money through 4 or 4.5 times to get a spread above SOFR of 5.5 to 6% with an original issue discount up front. Those are some pretty compelling returns over a hold period of 4 to 5 years that weren't there as recently as 12 or 18 months ago. And so the private credit market really has taken huge market share, not only from the banks, but from traditional ways that U.S. corporates have used to raise debt capital in the past. And I think that really benefits investors like ours that are seeking the best risk-adjusted returns they can get. I would also say in the current market environment, private equity secondaries offers some compelling relative value in terms of being able to buy high-quality assets at meaningful discounts to NAV. And it's always important to measure the risk you're taking for the type of return you're underwriting. And I think those two areas in particular, as of today, are good opportunities to deploy capital.
So you would say that today the flavor of the month or the flavor of the next 12 to 18 months would be what? Private credit and the secondary market?
Look, markets change quickly, so I don't know that I'd want to box myself into the next 12 or 18 months, but certainly in the next 3 to 6 months, those are good opportunities. We'll reassess that in real time as we go along, and that very well could be the case, but we'll make that judgment as market circumstances dictate.
So obviously the asset class is very interesting, but there's obviously risks, right? And as all asset classes, diversification is very important. Can you explain a little bit from your perspective what type of diversification an investor should look for in its portfolio?
Well, I think many smart investors over time have said that diversification is one of the only free lunches out there. And I would say that's as important today as it always has been. And as we look at diversification, we're here in Brazil, and Brazil is a very big country, and its economy is large, and it's growing. It's showing signs of growth. But when we put that in the context of the global economy, Brazil is a very small part of a very big global economy. And as we construct portfolios, I think it's important not to lose sight of the fact that building and managing a portfolio that should last and grow over decades needs to have content in holdings that are more reflective of the global economy as a whole, rather than just being too focused on a smaller domestic market of the global economy. And I'd also say it's important to make sure it's well diversified both in credit and in equity. We're in a period of time where interest rates have risen to their highest level globally in a long, long time, in many decades. But let's not get tempted to overdo it and go all in and go 80 or 90 or 100% on the credit side. You still need growth assets. And the importance of equity to give some growth should not be forgotten in a time to where we feel we can get low double-digit returns for first lien type risk in the marketplace.
And obviously portfolio, there's a lot of players in the world, but one of the things that at Carbyne we saw a lot of value in doing partnering up with portfolio advisors. It's your focus on the middle market, the U.S. middle market. Can you explain a little bit why the middle market is so interesting, and why people should start investing in the U.S. middle market?
I think the middle market is, and has been for a long time, the most single compelling segment to invest in across the world. And when we talk about the middle market, I think it's misplaced to say that there's a robust middle market in Europe or there's a robust middle market in Asia or other geographies. The middle market really is a U.S.-centric theme. I said earlier that there are approximately 180 to 200,000 private companies in the United States. And it's got a broad definition, but we like to say that the majority of middle market companies that we would define as have EBITDA between $10 and $75 million. It could be a little bit smaller, it could go a little bit bigger, but that's by and large what we would define as the middle market for our purposes. And if you were to carve out the middle market on its own, we estimate it to be the fourth or fifth largest economy globally. That's a lot of opportunity. And I think importantly, it allows us opportunities to partner with sponsors and buy businesses that still have a lot of room for value creation, professionalization, et cetera. We don't want to buy a company that's been owned by other private equity firms 4 and 5 times. We like to buy founder or family-owned businesses. Maybe it's been owned by a small private equity sponsor and we're next in line. The middle market, I think, should not be underestimated for both the size and the breadth of opportunity, but the real value creation opportunities that we can provide those companies and get what we think are very superior risk-adjusted returns. And I'd say the last thing that comes to mind is we have with the rise of the private markets, we have a very, I would say, open exit environment. We don't just rely on sales to strategics or an IPO window being open. There are so many big private equity funds out there that are looking for companies within that size that I outlined earlier that really allows us a much wider exit ramp than larger companies that you typically see that are completely reliant on strategic capital or on the IPO window.
The large private equity firms that you said, the universe, it's much easier to identify the opportunities because they're much larger firms. Can you explain a little bit why should an investor use a partner like portfolio advisors to enter the middle market because of the extra complexity of the landscape and all of that?
Great question. The middle market is our bread and butter. We've been in business almost 30 years now, and we've always been a mid-market specialist. And we have been instrumental in identifying and backing GP sponsors, in many cases their first fund or one of their early funds, in continuing to back them over time. We consider ourselves to be a solution provider, whether that be senior debt or junior debt to help them finance deals, whether that be co-investing alongside them in equity, whether it be providing secondary capital to facilitate transition of their LP base over time. It really allows us to be consistent, dependable, strategic partners to them. And look, we talked about the number of private equity opportunities out there in the middle market, but there are literally a few thousand mid-market private equity firms. And even if you are in the business full-time like we are, it's hard to keep track of them all. And then to build relationships and foster strategic partnerships like we have with them takes many, many years in doing so. But if you put yourself in a place like Brazil or elsewhere in the world, it makes it even harder to realistically identify and get to know and develop that long-term partnership with those middle market companies. And so we're able to be a conduit to global investors to really tap into our 30 years of experience in our relationship with those GP sponsors to provide them access either in credit, in equity, in primary funds, or in secondaries to take advantage of the secular growth opportunities in the mid-market.
So obviously we work in the market for over 20 years, so we know very well the definitions. So can you explain a little bit to our audience what are primary fund investments, secondary fund investments, and direct investments, so people get on the same page to know what we were talking about?
Sure. A primary fund investment is when a GP sponsor, a private equity manager, comes to you and says, I'm raising a new fund to invest in this strategy over the next 5 years. And you need to decide for yourself if that strategy fits within your plan and whether that's the right manager to execute that strategy. And then you commit a certain amount of capital that will be drawn over time and deployed as that GP identifies investments. It's also called a blind pool investment because you make a dollar commitment not knowing what the underlying investments are going to be. Direct investment would be when we participate directly alongside a sponsor in our case, because we do not lead deals ourselves, but we lead deals in conjunction with our GP sponsors. And so because we are a primary fund investor, in many cases, our sponsors will invite us to invest alongside them on a no-fee, no-carry basis directly into the companies. And it allows us to, in essence, reap the fruits of our longstanding relationships with those GPs and allow our investors the opportunity to participate directly inside those companies, in most cases at far superior economics than a primary fund investor would be able to do the same. And then finally, secondary investments. Secondary investments, I want you to imagine that you're stepping into the shoes of a blind pool primary investor when that manager comes to raise a fund. As a secondary investor, we, in essence, provide liquidity to original investors that 3, 4, or 5 years into the fund's life need liquidity for whatever reason. They could have an allocation that's come out of balance. They could no longer decide to invest with that manager and they want to redeploy that capital in other ways. They may have some financial distress and need to sell for whatever reason and not be able to hold on for the remaining 5 to 7 years of the investment. So we come in at that point in time and offer a cash price in most cases to basically take over the LP commitment from the previous investor. And what that allows us to do is a number of things. It allows us to avoid any potential poor investments that have been made up until that point. It allows us to really price the portfolio and ascertain the value for ourselves relative to what the reported NAV is. And I think Portfolio Advisors is very strategically positioned because we are a primary fund investor in a vast majority of the secondary transactions that we do. So we already know what the underlying assets are. We've got our own views on the valuation typically, but importantly, we're very close to the GP sponsor and we can have a direct dialogue with that GP sponsor to fine tune our own assumptions and underwriting beliefs in terms of what that portfolio is worth. And so it allows us to take a lot of risk out of what is typically associated with a blind pool. It allows us to shorten the overall holding period of private equity rather than us getting liquidity between years 5 and 10. Typically, we'll begin to get immediate liquidity, and rather than having it drag on 10 more years, it will run its course, say in another 5 to 6 years, depending on the age of the portfolio when we acquire it. But it's another way to get exposure to a general partner later in the fund's life cycle rather than up front.
So Scott, the time is over. Thank you so much for your time here. We hope to have you again here in Brazil very soon and do another event, another interview. So thank you so much for coming.
It's great to be here. You haven't changed a bit in 15 years. It's been a lot of fun.
Likewise. Thank you.